Hello and welcome back. Thank you for tuning in. You may call me a messenger of bad news today, it is up to you, but I have to tell you we're about to see a major banking crisis unfold, and here's why. Delinquencies on commercial real estate loans held by the US banks have been steadily increasing. Based on the latest inflation figures, the Federal Reserve will keep rates unchanged. They will keep rates higher for longer with a possibility, there's no certainty about this, but there's a possibility of a rate cut in June. I will remind you that January CPI report shows that inflation has increased. And this is a perfect recipe for a major credit event. We're talking about a systemic credit event that will result from commercial property values dropping while the number of bad loans is going up. There's more than $900 billion of debt on U.S. commercial as well as multifamily real estate that will have to be somehow refinanced this year. How can it be refinanced when the value of collateral is dropping due to high vacancy rates while interest rates remain high? Small to mid-sized banks hold approximately 70% of all commercial real estate loans in the United States, and their exposure is extremely high. Unfortunately, those are the banks that will be hit the hardest. Marathon Asset Management warned that small to mid-sized banks are moving toward an 8 to 10% default rate in their commercial real estate loan portfolio. That is billions of dollars in loans that will have to be written off. There was a research paper recently published on U.S. bank overall health and the U.S. banking system fragility. And according to this paper, 10% default rate would roughly equate to $80 billion of additional bank losses. But that is not the worst news. The same research paper focused on commercial real estate loans that account for about a quarter of assets for an average bank and about $2.7 trillion of bank assets in the aggregate. It says after recent declines in property values following higher interest rates and adoption of hybrid work patterns, about 14% of all loans and 44% of office loans appear to be in a negative equity, where their current property values are less than the outstanding loan balance. It goes on to say, after more than $2 trillion decline in banks' asset values following the monetary tightening of 2022, additional 231 banks with aggregate assets of $1 trillion would have their mark-to-market value of assets below the face value of all their non-equity liabilities. So effectively, this means that commercial real estate drop in value is causing borrowers to be upside down on their loans when collateral is worth less than the loan balance itself, simply speaking. Nobody will refinance that easily. The research concluded that commercial real estate distress could leave more than 300 mainly smaller regional banks insolvent. This is a major reason to be extremely concerned. I can appreciate the report that I just showed you because it is very straightforward and it gives us facts and numbers without trying to say, oh, you know what, it's really not a big deal. When the banks file their quarterly reports after the first quarter ends, I expect to see their bad loan reserves being much higher than before, than in prior quarters, and we're likely going to see them make fewer loans as they need to make sure that they do have access to additional funds. But don't expect banks to have enough reserves to cover their bad real estate loans. Financial Times is reporting that bad commercial real estate loans have overtaken loss reserves at the biggest U.S. banks after a sharp increase in late payments linked to offices, shopping centers, and other properties. The sharp deterioration took place in the last year after delinquent commercial property debt for the 6 big banks nearly tripled to $9.3 billion. And here's an excellent illustration of commercial real estate coverage ratio that compares 2022 versus 2023 loan reserves to delinquent loans. We're looking at the biggest banks in the United States here. That's how bad the situation is becoming. I will remind you that global asset managers have already warned their clients to limit their exposure to US commercial real estate portfolios. And if that's not a good enough sign that they are expecting likely the worst case scenario to unfold, then I don't know what is. In a recent video, I shared the details of the global bank contagion fears when a German bank openly warned of the greatest real estate crisis since the financial crisis of 2008. Fears of a broader contagion have already spread to Germany. Deutsche Pfandbriefbank, that focuses heavily on commercial real estate, is all of a sudden preparing for what is said to be the biggest property upheaval since the financial crisis 15 years ago. So to sum this up, as interest rate cuts are expected in June at the earliest, these banks will show more and more signs of stress with more delinquent loans on their books if vacancies don't decline, and they won't because of the hybrid and work from home arrangements. Vacancies would need to decline for landlords to see increased cash flow from their properties, which in turn would drive their valuations up. Unfortunately, that is unlikely to happen. So the only thing that we can hope for at this point in time is that the Federal Reserve works very closely and very well with its system banks to mitigate risks and to prevent the worst case scenario. It's also a good idea for anyone to do some research, to do some homework, and to figure out whether their banks are at risk in order to be prepared, of course. So thank you for watching. I hope that this video was helpful and that I provided some new information. Give this video a thumbs up if you enjoyed it, if you learned something from it. Make sure that you are subscribed to my channels both on Rumble and YouTube. Also, I have a second channel where I speak about taxes and personal finance. So you're welcome to become a subscriber there as well. You will find all of my social links in the description below. I would love to have you back for my next one tomorrow. Have a great rest of your day, and I will see you in my new one. Bye for now.